Hey everyone, Brian Bogner here, along with the most amazing Greg Towner, and it's time for our monthly 20-minute market breakdown. All right, it is August. School is starting back up. Summer's winding down. Traveling's winding down. All that stuff's happening here, and things are starting to get back into a little bit of a groove, a little bit of we're looking ahead. Actually, we're entering my favorite time of the year, which of course is fall. I love when the air starts getting crisp and getting cold and the leaves start falling. And of course, college football's coming up. Now, if we decide to talk college football, we wouldn't take 20 minutes. We'd probably take the next 2 hours to talk about the upcoming season, but we're not going to do that. We're going to focus on the market. And I'm kind of excited about today's episode. Greg, how are you doing?
Yeah, I'm doing great. We're definitely not going to talk about college sports realignment. That would be, a long conversation. But no, I'm doing good. And what I think I'm excited about for this call, Brian, is normally we're answering the things or talking about the things that we want to talk about.
Right.
Today, we're talking about the things that our clients want to hear. That the
Right.
questions we're most hearing. We said, you know what? Let's compile our, half a dozen or so most common questions and answer them today. So let's do it.
All right, let's get started. All right, first question right off the bat, right, which just happened here recently. Should we be concerned about the downgrade of the U.S. debt by, I think it was Fitch that did it. They downgraded it from AAA to AA plus. So what are your thoughts
Right.
around that?
Yeah, exactly. And this was obviously a super hot topic when it came out originally, already kind of died down a little bit. Yeah, I don't want to make light of it. There's definitely some important, points that they made and factors, but ultimately, I think this is a great example of what we often talk about. Avoid the kind of short-term noise. It's just messy headlines, even for potentially important topics. It's the headlines that scare people and get them to do things they probably shouldn't. So I'll start with that. I also think just the timing of their announcement was really odd. I mean, the economy, as we'll get into, is kind of strengthening, if anything. They talked about the divisiveness in the government. Well, I mean, that's not new. I mean, so it's just kind of weird, particularly considering you go back, it was 2011 that Standard and Poor's downgraded, the government debt, so our government credit. So it's been a while since then. So I think a lot of it was a little bit odd, but I think ultimately their points were valid as far as the level of debt, difficulty in reaching, debt agreements, that sort of thing. So it can't be ignored, but there are also some key differences between this downgrade and when the S&P downgrade
Right.
occurred. Yields were already in a decline then. They're upswinging now, so that's potentially a little concern. Well, let's not forget what stocks did after that last downgrade. They were a little noisy at first, but the next decade after has been terrific for securities, for stocks, right?
Yeah.
So
Yeah.
again, there's so much happening in the world at any given time. You can't isolate one factor, but we would say just best to kind of avoid this for the most part.
Right. Right. And do you think that that it could, the other thing that we're hearing too, and maybe it does relate a little bit into this, because let's be honest, yes, there is, this is interesting, in terms of the timing, but there is a level of debt here that does need to
Sure.
be where, there is concern about that. And there is a risk there, no doubt. Now, whether that's, 5 years from now, 25 years from now, we don't know,
Right.
but right. So some people think is a recession on the horizon then. Oh, they just downgrade because right, they downgrade our debt. Are we potentially heading into a recession?
Yeah, I mean, I don't think that the downgrade of the debt in itself is not going to cause a recession. I mean, certainly if you look at economists have started to change their tune. We've talked about how seemingly every economist last year and early this year thought we were imminently going into recession. I mean, not only has that not happened, but the current estimates are showing the economy to continue to increase in strength. How long that lasts is hard to say. I mean, certainly things could, get worse, and we're going to talk about some risks later in this call, I think. But
Sure.
I think by and large, you can't make a recession call right now based on what we're seeing, and certainly
Right.
not based on this downgrade of credit. The U.S. dollar is still the reserve currency in the world, so I think people realize the strength of the
Right.
U.S. Treasuries are still viewed as the strongest. So
Yeah.
I don't want to say this is complete noise, but I think it's best to be ignored and treated as noise by most investors.
Right. Look, people are still working. They're still spending
Yeah,
money. There's, the economy's still popping and going. People are traveling. People are like, you're always going to have some things like that, but people are still doing stuff, and we're not seeing that
yeah,
change at this point. So,
absolutely.
all right,
Yeah,
changing gears a little bit. again, we talked a little bit about interest rates going higher here, and they certainly have here over the last couple of years. So we've been getting a lot of questions about, okay, there's a lot of banks now offering these CDs, right, at a high rate, right? Or a money market or something like that. So let's talk a little bit about, we're getting questions like, what's the difference between a CD and a money market?
Yeah, and I think that's a good question. I think it's a good reminder for us sometimes too, Brian, to not ignore the kind of the investing 101 stuff that we take for granted, and make sure that everybody's really informed on some of these things. So a CD, as most people know, a certificate of deposit, is generally issued by your bank, at a set rate for a set amount of time. There's typically a penalty if you want to try to get out of it. Has its pluses and minuses. A money market fund, trades like a mutual fund. You buy or sell it. It maintains its principal value, but then it pays out interest. Invests in a variety of instruments, maybe short-term treasury bonds, maybe commercial paper, some other kind of repurchase agreements, a variety of instruments. But it has liquidity. You can sell it at any time you want. So it's a big advantage from that aspect. It is not FDIC insured, so some people, are concerned about that. Most CDs are, depending on how much you're putting into it. But there's good and bads of both. I mean, we saw last year when people started to get really concerned about the market and rates were better, they started to put a lot of money into CDs and money markets, especially CDs, because oh, wow, look at that high rate. Well, now rates have gone up a lot, and that rate that they locked into at doesn't look so good anymore.
Exactly.
If they hadn't locked up their money, they could be putting it in at more attractive rates. So, the being locked into CDs can be both good and bad. We utilize both. We have the ability through, say, Schwab, to look at CD rates all throughout the country and look at the best ones. But we also think the money market's great from a liquidity standpoint. So those are the big differences.
And let me just add one caveat to it. If you're listening and you are getting something from a bank talking about their CD rate or something along those lines, the smaller banks right now are really having a challenge getting deposits in. And so they're offering some of these outsized rates, and some of your smaller banks do that. A lot of times on the lending side, they'll do maybe a little bit further than they should be doing. And on the deposit side, they sometimes offer higher rates, just because they're not as well capitalized as some of the bigger, stronger players. So just be careful, when you see a very nice rate out there being advertised by a bank, maybe you never even heard of before. Okay. But give us a call and have that conversation with us, please. So if you see something, look, 2 years ago, we weren't talking about this. Nobody cared because they were all paying nothing. Now they're actually paying decent rates. So it's worth a conversation. So before you go tie your money up somewhere, give us a call and let's talk about it. All right. Next question. How frequent are market corrections historically, right? So we've had this big move up this year, right? And we're kind of starting to stall out a little bit from the big move up we've had since the beginning of the year. So let's talk a little bit about market corrections. Seems like we're probably due for one this year. So how frequent are they historically?
Yeah, I thought this was a good, timely question because, like you said, the market has moved up steadily this year, kind of defying a lot of people's expectations. But now we're finally starting to get some volatility in a normally weak seasonal period. So it's good to kind of remind everybody how frequent corrections occur. And I have a lot of numbers here, but I'm going to try to keep it as simple as I can. So, this first study goes back to 1950. Small corrections, say in the 5 to 10% range, very, very common. It's occurred 124 times. Right? This study is a little bit old, I think 4 years old. So the numbers don't matter so much. It's kind of the theme. Very common to have those small corrections. If you're talking about a 10 to 15% correction, it's happened, maybe 30 to 40 times, something like that. Okay. Then as you get up into the bigger corrections, 15 to 20%, it's happened 7 to 10 times. And bear markets, maybe 13 to 15 times. So the point being, those small corrections happen very, very frequently. I mean, you could count on 1 or 2, maybe even 3 a year sometimes. The bigger ones are more rare. The average correction comes out to about 14%. But yet, despite that, in 32 of the last 43 years, markets finished higher. So corrections are a normal thing. But we also like to say that corrections can also occur with time.
Right.
We've talked about how we think the market is going to be kind of trading in this sideways manner for a while, and it has been. So yes, the market might go up and down during that period, but sometimes a lot of time has to go by too to kind of exhaust investors to realize what's happening. But I mean, we certainly should remind everybody that it's part of the game. Corrections happen. If you're trying to achieve the long-term attractive returns that investing is achieved over the long term, you're going to have to be part of corrections.
Yeah, and I go a step further and I say a healthy market has healthy corrections. You know,
Oh, yeah, I
typically
like
a
that.
market where you don't see corrections and things just keeps edging higher and higher, then that means when it comes, it's going to probably
Yeah.
come pretty hard and fast and smack you across the face. Whereas if you have some healthy ones along the way, it just gives time for things to digest and to be a lot healthier move. Okay. Well, speaking of corrections, kind of along those lines, you know, what are some concerns? What are some risks you're seeing on the horizon here with the markets?
Yeah, I mean, obviously, we're always monitoring a variety of concerns and risks. I will say that right off the bat, most of the time, the things that really hit the market are something that no one's even looking at or thinking about. So most of it's unpredictable. But some of the things that we've been looking at, we think there's a possibility that commodities could have a pretty big rally at some point. Hard to say exactly when that will be, second half of this year, next year, hard to say. But that could lead to kind of a second wave of inflation.
Right.
We still are in the camp that inflation still has some further downside potential here, but at some point there's a risk of a next wave of inflation, and I don't think the Fed will take too kindly to that, and so that's a risk that we're monitoring. Speaking of the Fed, they're potentially done raising rates, but not for sure. And if they kept going higher, I think that poses a risk to the market. But even if they don't keep raising rates, we know that historically, when they do tightening like they have here over the last year, it's kind of a lagged effect. It takes a little while for all that to get into the system and tighten things up. So there's still potential that could occur, even though, like we said earlier, it's not occurring economically right now. So that's a potential. I'd say valuations from a broader market are neutral to slightly against us, but there are certain areas of the market that have high valuations, and that kind of draws down everything as far as appeal. But as we'll get to, there's certain areas that are not that case. But if short-term rates keep going up, there's certainly competition, as we've seen. Everybody loves their money markets at higher rates. It offers a little bit of competition from a valuation perspective.
Right.
And then, in my opinion, the biggest risk out there, hopefully there's a low probability of it happening anytime soon. But if it was to occur, it could have the most damaging effect, is if China attacked Taiwan.
Yeah.
Both economically and financial markets, that would be a really, really negative. So that's hopefully something we don't have to see, but we'll talk about that more down the road.
Right. So. Right. Okay. Yeah. Good stuff. All right. Are you seeing any opportunities right now amidst what's going on to invest in this market?
Yeah, I mean, no matter what kind of market you're in, I think there's always opportunities. I mean, unless you're just in some brutal bear market, then that may not be the case. But that's where cash as an investment comes in. But to us, I mean, we're seeing valuation and some opportunities in areas like energy, a little bit starting to see in select areas of financials, not necessarily the banks per se. A little bit of materials, again, with the commodity theme. We think there's going to be some opportunities in healthcare. Maybe it hasn't quite happened yet. We've been really attracted to some industrial companies that have done well. They're not necessarily cheap on a valuation perspective, but they're really benefiting from all the spending that's going on fiscally on the infrastructure plans, clean energy plans, that sort of thing. So that's a big boom. And then more broadly, emerging markets. I mean, they're definitely very volatile, but I think particularly if you were to see the dollar decline some, their valuations are cheap. I think there's some opportunities there. But to us, it's not just the same old big cap growth stocks that you have to be invested in. We own a lot of those, and we like a lot of those from a longer term perspective. But there's always opportunities under the surface that we find appealing now and often.
Yeah, for sure, for sure. Well, good. Well, those are the questions that I have written down here that we've got. So let's go ahead and close this out like we normally do, Greg. We're trying to stay at near as close to 20 minutes as we can. I know we feel like we do go over a little bit here, but what are some things on your mind? What are some of your recommendations for us this month here?
Yeah, I've got a couple, one financial one and one fun one, and I'm going to double down. I'm pretty sure I gave this one last year at this time, but that's how important it is, I think.
You did, yeah.
The Little League World Series. This is a down period for sports right now. Football hasn't started. Dog days of summer for Major League Baseball.
Sure.
But the Little League World Series is fun to watch from Williamsport, Pennsylvania. Those kids are really into it. They're enjoying it. back kind of the roots of the sport, you know, sportsmanship, that sort of thing. So just watch a little bit. The kids are having fun out there, and you know, it's fun to watch. So that's from a fun perspective. Tune into that. But from an investment perspective, you know, we talked on it a little bit earlier when we were talking about money markets and CDs and all that. You know, I know a lot of people have moved their spare cash into those things, and that's great. But it's amazing still how many people have excess money in their savings or checking or what have you. If it's not money you're going to be needing immediate liquidity on, you know, talk to us about some short-term cash opportunities that we see to get you a better rate and to
Right.
put that money to work. And I just think, you know, with the rates where we are, like you said, we spent years earning nothing on them. So now that we have those opportunities to earn it, let's take advantage of it.
Absolutely. Absolutely. If you got cash sitting in the bank right now, and it's just in a checking account and it's a good amount of cash, give us a call. We've got some great options there for you. All right. My two recommendations on the personal side. Okay, Greg, I'm gonna have to pay homage to you because you recommended this like a year ago. And you know, I'm loving what Netflix is doing right now with documentaries. I mean, they're just doing some really cool stuff, whether it's Formula One racing, or you want to, you know, the Murdaugh murders, you know, of course, here in South Carolina, that got all the attention. But there's some great documentaries out there. And you recommended this one a year ago. I finally watched it this summer, which was the Tour de France one. So it wasn't this year's Tour de France, it was last year's Tour de France, right? Or I think they did it on.
Yeah, it was covering last year's tour, but it just came out in the last few months. Yeah.
Okay. Well, you recommend, whenever it came out, you recommended it. All right.
All right.
I will tell you, it was amazing. I was laughing. I was crying. I was in it. What these cyclists have to do, the way they, I mean, it's unbelievable what they have to put themselves through physically, mentally, emotionally, spiritually, even to get and perform where they need to perform. Whether you have watched cycling or not, you will thoroughly enjoy this. I guarantee it. Just even getting to know, I tell you what, I have a greater deep appreciation for the sport because I know who these cyclists are now, and I know some of their backstory, but just watching what they are doing in those races and what they are going through, it's unbelievable. So that is my recommendation there. And the last thing I'll say on the investment side is, I just want to echo what Greg said earlier. There always is an opportunity. Okay, no matter what you're reading in the headline, no matter what you're seeing, there always is an opportunity. And there are some great opportunities right now, whether that's just parking a little bit of cash or some cash somewhere and getting a great return, or even in the market, there are some opportunities there. We're here to help. We're here to talk you through it and help you discover what they are, obviously, and what's right for you and makes sense in your financial plan. So give us a call. We'll be happy to help you. Thanks so much for listening to our 20-minute market breakdown here in August, and we will see you next month.